We begin from where spot gold started this year, 2025. Internationally, bank analysts are still banging the table for $3,000 an ounce gold. Have a listen as he runs through medium-term minutia for his call.
So from our perspective, there definitely is a pathway to 3,000. Our end of year 2025 target for gold is 2,900 per troy ounce, so a smidge off that 3,000 number. Look, what is driving that? Look, in the end, what is driving that is that gold is the ultimate credit hedge. And by that, I mean every currency, every fiat currency in the end is, to some extent, a limited extent, but still some extent, a credit trade. Fiscal profligacy seems to be the order of the day in the US with the incoming administration. We just heard from the previous person about this. So that ultimately should form a relatively robust backdrop to gold appreciation. The one thing that I will say is you pointed this out, obviously fiscal profligacy comes at the cost of a stronger dollar, and that stronger dollar is ultimately bearish commodities, and in particular bearish gold. So that's the one factor that's offsetting it. Timing it is really the question here. It's not the if we will hit 3,000, it's when we'll hit 3,000 or 2,900, and that's a much more complicated thing to get right.
Ben, you pointed to an interesting contradiction which has been in place for some time now, and that is gold and a dollar have been moving in the same direction.
What the interviewer is referring to is the false thinking that in order for spot gold to perform well, you need to see falling fiat US dollar and relative purchasing power to other competing major fiat currencies. This was not really the case recently, with spot gold reaching its latest all-time nominal spot price high near 2,800 an ounce late in October 2024. This happened in the face of a rising US dollar index at the time. We'll speak to this false dichotomy with a longer-term chart in just a moment. Onward with the clip.
Which isn't usually the case, right? The classic relationship is inverse. They move in opposite directions. If you think gold 3,000 is a matter of when and not if, how is that going to happen if dollar continues to stay strong? If not, get stronger?
I think that is exactly the question. Who's going to win this tug of war here? Like you pointed out, usually you have an inverted relationship. The question is, when the world is going to normalize. And quite frankly, my guess is as good as yours here.
Throughout this full fiat currency era, we've run through timeframes in which the fiat US dollar index has surged to dramatically high levels, for instance in the 1986 Plaza Accord era, only to have the index ramp down with a secular US dollar bear market, one in which gold continued for some 15 years following in a secular bear market of its own. Yes, there were other major secular fiat US dollar bear markets to start the 2000s to the 2010 top, basically gold running 4 times or 4-fold multiples from around 250 an ounce to a peak of 1,000 an ounce in early 2008. But we've also witnessed spot gold do another near 4x multiple in spot price from the global financial crisis 2008 low of near $700 an ounce gold, when safe haven fiat US dollar index spikes were happening at the same time. Basically, we've had ever since an overall upward trajectory for the fiat US dollar index relative to other competing fiat currencies ever since. Basically, spot gold price fourfolded throughout both eras, being US dollar weakness or strength. You've probably heard the expression that the US dollar is the prettiest horse at the glue factory. John Exter, the former Federal Reserve governor, his 1968 inverse pyramid expressed just that view. In a crisis, the fiat US dollar in physical cash notes is the safest haven, second only to gold bullion owned outright. From what I'm seeing, it appears another crisis is brewing. Central banks have been increasingly moving out of underperforming bonds and into buying new gold bullion reserves at record pace the last 3 years running, buying about 1,000 metric tons or just over 32 million ounces of gold per each of the last 3 years. This while Western unsecured gold ETF shareholders have basically been net sellers in a rising spot gold price environment. Spot gold is up nearly 70% since the decade began, yet bonds have lost purchasing power, signaling their secular bear market underway. Delusional U.S. stock bulls are now more than ever in record polling, expecting stock prices to rise over the coming year. This bullishness coincides with top 10 stock market concentration, mainly tech-driven domination, since the late 2010s until now, beginning 2025. The last time the top 10 stocks accounted for this much of the U.S. S&P 500 was just before the Great Depression in 1929. Of course, this stock bubble could go on, but underlying issues are spiking. U.S. consumer credit card defaults are rising, akin to what we saw after the 2008 global financial crisis. Delinquency rates on office commercial mortgage-backed securities are now higher than the fallout following the 2008 global financial crisis as well. Yet even with bonds performing terribly, the overvalued U.S. stock market has kept the typical 60-40 stock-to-bond portfolio buoyant, moving sideways over the last few years. With the new Trump administration threatening new tariffs against virtually all sorts of trading counterparties to come, it's hard to imagine this year will be a smooth one in global financial markets. The fiat Chinese yuan is back again, buttressing up against 7.3 yuan to 1 USD, a level that, if they were highly tariffed, will likely break to the upside. And similar to their negative 3% devaluation of the yuan in 2015, that could again break chaos in global financial markets. Judging by the Chinese 10-year bond crashing off a cliff to close last year, 2024, big moves in markets are being signaled for those who bother to look around to the other side of the world. Record Chinese gold buying has mainly been driven by this, a real fear of coming fiat yuan devaluations upcoming. The spot gold and silver prices in China are showing this fact already. On the other side of this break, we're going to take a deeper gander at the silver market, particularly where it has been since COVID 2020, and where it is at the moment on the retail side, and what we're going to be refining through as the inevitable climb back towards the seemingly ancient nominal price high of $50 an ounce is again coming around the bend. Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates, and be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce silver coin giveaway.
What's better than an ounce of free silver? How about 500? Get ready for another monster-sized giveaway with the SD Bullion Monster Box Sweepstakes, featuring 500 of SD Bullion's very own Silver Tree of Life coins in a monster box. This highly detailed piece of silver is a beautiful addition to any collection, and it features a hidden inscription on one of the tree branches that changes every year. So don't miss out on this exciting silver giveaway from SD Bullion, because someone has to win it, and it might just be you. Click the link below for your chance to win.
Make sure you enter our new 500-ounce silver bullion coin giveaway sweepstakes for 2025. The link to the new contest is below. The winner of the 500-ounce silver bullion coin giveaway from 2024 will be announced the week of January 13, 2025 upcoming. You will find the winner's name published on our official sweepstakes URL, next to winners from 2023, 2022, and 2021 respectively. I'm going to be traveling late this Friday evening when this update goes live, thus I'm creating this week's bullion market update one day in advance. Both spot silver and gold are slightly up since the ending of trading last week, the 27th of December 2024. The spot silver price is threatening a run back towards 30 an ounce, while spot gold has cleared the 2,650 an ounce mark here on Thursday, January 2nd, 2025. The spot gold-silver ratio climbed intra-week, peaking over 91 just before the first day of the new year. Technically speaking, for all the lower 70s spot GSR shot callers, you're going to want to see 91 hold and not get broken to the upside. Industrial silver usage continues breaking records in terms of troy ounces used in myriad inputs, from solar cells to cell phones to cars, and hundreds of other industrial uses for silver that continue improving the quality of our modern day lives. A healthy bid for silver higher in China than the Western world continues, reflecting the fact that they need physical silver to continue pumping out consumer items like world-leading car and solar panel production. Yet for brick and mortar street level dealers in the United States of America, we're seeing signs that items which were once circulating money are now often being refined back into purer forms to help better meet ongoing 3-9 fine demand from industrial silver users and silver bullion investors alike globally.
Hey folks, what's up? This is Brian Kuzmar with Commercial Rare Coins and Precious Metals in beautiful Lauderdale by the Sea. Something a little different here today that I wanted to do. I haven't done a video for a little bit. The video is, where do these great products that you buy, 100-ounce bars, Silver Eagles, all the modern products you buy, 10-ounce bars, which I'm going to grab one right here, all kinds of cool stuff like that, happens to be a Royal Canadian Mint bar. Where does a lot of that stuff come from besides mining? Well, a lot of it comes from the scrap industry. Less and less every year, but I wanted to kind of show you what we do here. And a lot of your silver comes from scrap, or did in the past. Again, not as much as we currently, or not as much as we did in the past, but a lot of your silver would come from scrap materials like this. Now this is what we call flatware in the industry. There just happens to be a lot of flatware in this 55-gallon drum. We're going to kind of show you some other products that we also do, which is get scrap, which is a lot of foreign silver coins. I'm going to kind of do this for you right here, and we'll pour that in here. And this stuff is that we buy from other dealers mostly, especially the flatware stuff. The flatware, and I'm going to point down here and show you hollowware. And it's on the floor for a reason, because before we put it in the barrel, we typically smash it, and I'll show you that in a moment. But this is where a lot of the scrap metals that people sell to coin shops and jewelry stores and antique stores and estates and things, this is where it ends up in 55-gallon drums, and it gets turned into bars, 100-ounce bars, 1,000-ounce bars for industry. These happen to be Canadian silver dollars. Now, some people are probably saying, oh my God, I can't believe you're melting Canadian silver dollars. Well, we do, and the problem is that nobody buys them. There's no premium for these whatsoever, and the bullion market has slowed down quite a bit. That there's not a lot of retail buyers out for this stuff. Let's kind of pull up a few more bags here. I think between these three bags, that probably represents 700 and 750 ounces, just the bag I poured in there, and the bag that you're looking at right now. Let me kind of cut that one open real quick, and let's see what's in there. Again, this is what I do on a daily basis. I don't necessarily do all this cutting and pouring work, but as you can see, I don't mind getting my hand dirty. And here we go. More Canadian, it looks like 800 Canadian. And so we've got flatware, we've got coinage down there. And again, what I was telling you is a lot of hollowware. Less and less every year. If you look down here, you'll see that, you know, we got hollowware, and to get it into a barrel, you know, a lot of times we'll, pardon the noise here, and those are pretty easy to do, but it really has to be done, because it's really all about getting as much in a barrel as you can to effectively make it worth shipping and all that stuff, and that's a little heavier gauge. Teapots, well, there goes Grandma's teapot, but I don't need to do too much of that to show you where this stuff goes. It goes into the barrel and turned into silver bars, silver coins, and I would say as recently, the problem is that we don't have a lot of silver sales right now, so I think a vast majority of the stuff that I got in this drum is going to end up in 1,000-ounce bars, or in the industry, or inside your car. And I know that sounds funny, but Grandma's silver service, you know, Aunt Betty's hollowware, you know, her tray from her table that she used to put nuts or bananas in, or whatever it was, is going to end up in the back of or inside somebody's car. It's going to be a component in someone's car that's made out of silver. It's going to be a battery or something like that. So that's where this stuff ends up, folks. I just kind of want to give you a little lowdown, and as you can see, it's not limited to just that kind of stuff. You know, Franklin Mint coinage. If you look down there, you'll see candlesticks and all that stuff. But the problem with this stuff too is, again, you got to crush it before you get it into the barrel. So there is some work to doing this. This is not, people say, well, boy, what a great job. Or it's a white collar job. You don't have to do any labor. Trust me, we do. And another thing here, these barrels, probably by the time we get done filling these barrels up, and I'll kind of shake this if I can, that's nearing probably 500 pounds pretty soon. That's probably about 450 pounds. The barrels weigh about, what, 30, 40 pounds or something like that, the steel barrels. So that's about 50 pounds of barrel, and excuse the noise there. And obviously you can tell it never ends. We get a lot of this stuff in, but don't be mistaken. There was a time a couple years ago in the past where we would have 2 barrels sitting here, and we were constantly getting barrels in and out. The scrap business in the United States has slowed down dramatically, and if you haven't noticed that, you probably noticed that even with gold prices way up, you haven't seen the buy it now guys that we've always seen in the past. But that's pretty much it for that, folks. I just kind of wanted to explain this little situation of what we do, and where your silver bars may come from, and where the silver in your car, where the silver in your batteries and your devices may come from as well. It's this kind of stuff.
It's not only older 80% junk silver Canadian coins that get refined. In the late 2010s, the silver bullion market was so slow that we heard of large amounts of old US 90% silver coins being sold for scrap at the time, as dealers needed to find ways to turn some profit in the face of next to no demand at the time. Price premium charts for 90% US silver coinage since the 2008 global financial crisis basically illustrate that there have been about 5 time frames of premium spikes for 90% silver coinage over the last 15 years. Of course, during those time frames, 90% silver coin turnover and often end up in new investor hands as opposed to being refined into 1,000 ounce industrial silver bars or other silver bullion items. But to his point about silver recycling on the street level being lower than it once was, just over 170 million ounces of silver supply came via annual recycling of silver since the COVID 2020 boost in bullion and precious metals interest. This is still far from the typical over 250 million an ounce of silver being recycled back during the 2011 run to 50 an ounce, and spot price points akin to what are being projected by many bank desks for this year, 2025, for silver. Of course, now in the mid-2020s, global demand for silver is up over 200 million ounces or more per year, and recycling does not appear to be able to make up for ongoing annual market deficit shortfalls. Now looking backwards further to the first half of this decade in the silver space, specifically the Q1 2021 silver squeeze Reddit phenomenon. Chris Marcus of Arcadia Economics, in the middle of last month, December 2024, had Rick Rule onto his show, the former president and chief executive of Sprott US, to speak about his experience managing closed-end silver ETF fund PSLV, which had large capital inflows during the early 2020s. Listen to Rick as he speaks to how thin the market was and likely still remains, awaiting the next inflow of investment capital into the silver sector.
This actually goes back to the silver squeeze in 2021, amazingly, almost 4 years ago now. And obviously a lot happened there, although what I found particularly interesting, you were running or involved with the PSLV trust back then. And I heard a couple of interviews where you mentioned that, initially it was more just the retail product that got caught offside on that one weekend. Yet later, as more money kept coming into PSLV to fill the demands, because you can't have, the metal's coming or it's over here, we're going to get it. And you talked about how you cleared out a couple of different cities of their silver supply. And perhaps we could start there, and then I might have a couple questions to tack on.
That was an interesting experience. I had anticipated that the silver market was broad enough that it could accommodate our demand in almost any size. And while the silver market is very, very, very broad, the silver market was then, and I would suggest is today, much more liquid, or much less liquid than you believe. While there's a lot of supply in places like private ownership by the Indian peasantry, that isn't good delivery silver. And in the case of the Sprott Physical Trust, we could only buy silver that was, in the LBME or in the COMEX good delivery form.
Right.
And we were having days when there was $50 million of inflow into our physical silver trust. No problem, says Rick. We clean out Toronto. Okay. We go to Montreal. We clean out Montreal. Interesting. Well, no problem. We go to Chicago. We clean out Chicago. This is becoming concerning. The market's front running us. We go to New York. We clean out New York. It turned out that London was ultimately able to accommodate us. But London wasn't able to accommodate us overnight, which is what we were used to. We were used to buying silver and having the silver go from somebody else's pile in a vault through a screen to our pile in a vault. What happened was that we cleaned out all the piles until we ran into the final piles in London and Zurich, which accommodated us. I actually think that the young adherents to the silver squeeze were onto something. I think their problem was that they bought a long-term narrative and they took in short-term tactics. I actually believe that there are imbalances in the silver market, in particular between the physical market and the paper market. And that's what we ran into. There's tons of silver that trades every day in the physical markets. Some days, 100 times more silver transacts in the paper market than exists for good delivery in the physicals market. It was our bad fault. It was our bad fortune to run into that, literally. Chris said, we got through it, but it contributed to my baldness.
Oh, you still look good. You got plenty up there.
But I think that the people who were interested in the arithmetic around the silver squeeze didn't understand that they needed to be persistent and tenacious. In other words, that the unraveling of the dichotomy between the physical market and the paper market could take 5 years to unwrap. And many of the youngsters who were involved in the silver squeeze had a much more limited time frame. They wanted it to happen in 5 weeks or 6 weeks. And I suspect that many of them employed much too much margin. If you're paying margin interest for 5 years, if the event that you're hoping to participate in takes 5 years and you're paying 8% a year, you might not be early. You might be wrong. Yeah. If you're an interest payer. And I think that's what some of the youngsters in the silver squeeze ran into.
Yeah, and interesting you mentioned not 5 weeks, but 5 years. We're almost 4 years in, so maybe next year will be the year. Although, Rick, I remember shortly.
Well, remember that a lot of the retail participation in the silver squeeze abdicated. They haven't held the silver for 5 years. When silver didn't meet their expectation, they liquidated in favor of meme stocks, in favor of Bitcoin, in favor of some other speculative asset. So 5 years would have involved them continuing to, in their parlance, stack. That didn't happen. They decided to take on the banks, and the banks kicked their ass. Let's get this straight. It doesn't change the equation. What the silver apes hope to cause to occur will be done by the market in the market's own time. It will take place, likely without the apes.
So you still do see that as an event that can we say is a matter of when rather than if, a statement
Absolutely.
I know you like to use?
Yeah, I mean, the disconnect between the futures market and the physical market is as broad as it ever was. And the disconnect that we at Sprott faced, which is to say the temporary increase in demand relative to the system's ability to effectuate good delivery supply, is there. And we weren't big buyers. You'll recall that at that point in time, over the course of a year and a half, we probably accounted for $1.5 billion or $2 billion in demand. We were the players because we were the only instrument that took silver out of circulation. The ETFs ebbed and flowed on a daily basis. When the market replaces Sprott, which will happen, that really truly changes the equation.
Yeah, I could certainly imagine that, because shortly before that happened, let's say between Silver Squeeze and that summer, there was a report from the LBMA, I think it was in April of that year. They mentioned, had the demand continued at that pace, that they were weeks away from running out, which I certainly took notice of that statement. So based on what you're saying, are able to venture any sort of feel for how close do you think back in 2021 when this was happening? You said eventually in London they were able to fill what you needed. Are you able to get any idea of how close we actually might have come to a break point back then?
Not a clue. If what happened at that point in time would have been accompanied by a liquidity squeeze, a market event like 2008, it would have been game over. If you would have seen credit restricted in the futures market against good delivery failures in the cash market, it would have been game over. Now, understand that you wouldn't have had a short squeeze like you have in a fair market. The LBMA would have declared something called force majeure, and they wouldn't have demanded settlement in silver. They would have cash settled. And the exchange, would have determined the cash settlement price, just like they did in the tin market. So part of the premise around the silver squeeze, which suggests that we had a fair market in silver, that the exchange isn't controlled by the dealers in the exchange, is false. That notwithstanding, people would have made a lot of money.
Yeah.
Understand, too, that the failure to deliver didn't reflect overall physical inventories in the silver market. It involved good delivery, silver, the silver that is the stuff of the paper futures, and the inventory that is required for responsible investment vehicles like Sprott Physical Silver. Over time, if institutional demand and retail demand for silver continues, what you will see is a dishoarding of informal silver, silver held by living, breathing human beings in the Middle East and in South Asia, and the reintroduction of that silver into the formal system, provided it doesn't happen all at once, provided it happens over time. And I think that this process probably accelerates. You're seeing a conversion of informal silver to formal silver in China, as an example. I think really the possibility for a cataclysmic break really has to do with how rapidly the market would be challenged. We were a catalyst that challenged that market, Chris. And to be honest with you, a fairly small catalyst. The fact that $1.5 billion or $2 billion in net buying had that dramatic an impact on the physical good delivery silver market let me know just how leveraged the futures market was.
Yep. And you mentioned in there that at some point you could foresee silver coming from private holders and then going into industrial uses. We've actually had reports from a couple bullion dealers this year that is already beginning. I'm guessing you might be aware that there's been a lot of retail selling in silver over this past year and a half. So seeing that to some degree. And I guess the question that this all leads to is that, given what you just described, what was happening then, and in the past couple of years, we've had the Silver Institute report deficits for 3 to 5 years, depending if you count the ETFs or not, reporting another large deficit on track for this year. So I've wondered if we were that close, and and you touched on how sometimes there's a matter of you don't have silver in a certain form versus silver exists somewhere that could be refined into that form. So I guess just if you could put it all together with what you described, and that we see deficits reported, if you have any comment on whether you have a different feel for whether there is a deficit or not. But
there is certainly a deficit. Understand that the fabricators, the people who are making silver panels, don't need LBMA good delivery silver.
Right.
They could care less. They are not fiduciaries storing it on behalf of third-party investors. They are people who are using metal for its reflective property. And to my knowledge, there is no major fabricator that is experiencing delivery failures. The supplies of industrial grade silver and silver alloys relative to the industrial demand is very much intact. That's still a very robust market. I think that you're seeing leakage from retail holders because retail holders are bored. They don't need it to make mirrors. And I suspect until you have seen sufficient momentum established by the gold market that generalist money comes in the silver space, that circumstance continues. It will continue until it doesn't. I realize that doesn't make a very good internet headline, for a video, but that doesn't matter much. Your viewers need to understand that precious metals markets are very much intact, that traditionally a precious metals bull market has the momentum established by the fear buyer, the gold buyer. And at some point in time, when the narrative establishes itself, either because of news flow or some other reason, that silver replaces gold as market leaders. I don't know where we are in the market. Nobody else does either, although some people pretend to know. I just know that this is a question where the answer begins with when, not if. Yeah. And if that answer isn't sufficient, people should do something else with their money.
I think that's fair enough. And
unfortunately, and fortunately, Mr. Rule, I've been red-pilled regarding relative fiat US dollar strength versus bona fide bullion over the long term. For me, silver bullion sub 50 an ounce remains a long-term store of value, even if my hair turns silver along the way. That will be all for our weekly SD Bullion Market update. And as always to you out there, take good care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.